Investing in stocks can be an efficient way to build wealth over a period of time. Learning how to invest wisely and with patience over a lifetime can yield results that far outpace the most modest income. Nearly every member of the Forbes 400 wealthiest Americans made the list in 2019 because they owned a large block of shares in a public or any private corporation. Basically, it all starts with understanding how the stock market works, what are your investment goals, and if you can handle a lot or just a little bit of risk. So, first, we'll understand what are stocks. Stocks are equity investments that represent legal ownership in a company. You become a part owner of the company when you purchase any amount of share. Corporations issue stock to raise money and it comes in two variations, common or preferred. Common stock entitles the stockholder to a proportionate share of a company's profits or losses, while preferred stocks come with a predetermined dividend payment. Now let's understand what are dividends. Dividends are quarterly payments that companies send out to their shareholders. Dividend investing refers to portfolios containing stocks that consistently issue dividend payments throughout the years. These stocks produce a reliable passive income stream that can be beneficial in the retirement. You cannot judge a stock by its dividend price alone. However, sometimes companies will increase dividends as a way to attract investors when the underlying company is in trouble. Now understand about investing in stocks. You can profit from owning stocks when the share price increases or from quarterly dividend payments. Investments accumulate over time and can yield a solid return due to the compound interest effect, which allows your interest to begin earning interest. For example, you might make an initial investment of $1,000 and if you plan to add another $100 every month for the coming 20 years, then you will end up with $75,457 after an exact period of 20 years. Even though you only contributed $25,000 over that period, if you see an annual return of 10% interest. Now I'll tell you why the stock price fluctuates. The stock market works like an auction. Buyers and sellers can be individuals, corporations, or the governments. The price of a stock will go down when there are more sellers than buyers. The price will go up when there are more buyers than the sellers. A company's performance doesn't directly influence its stock price. Investors' reactions to the performance decide how a stock price fluctuates. More people will want to own the stock if a company is performing really well, consequently driving the price up. The opposite is also true when a company underperforms. Now understand about the stock market capitalization. A stock's market capitalization, also known as the stock market cap, is the sum of the total shares outstanding multiplied by the share price. For example, a company's market cap would be $50 million if it has 1 million outstanding shares priced at $50 each. Market cap has more meaning than the share price because it allows you to evaluate a company in the context of similar sized companies in its industry. A small cap company with a capitalization of $500 million should not be compared to a large company which has a market cap of $10 billion. Companies are generally grouped by market cap into small cap. Small cap companies are from $300 million to $2 billion. Another one can be the mid cap companies. They are between $2 billion and $10 billion. The last one are the large cap companies, those who are $10 billion or more. Now let's differentiate between stock value versus price. A company's stock price has nothing to do with its value. A $50 stock would be more valuable than a $800 stock because the share price means nothing on its own. The relationship of price to earnings and net assets is what determines if a stock is overvalued or undervalued. Companies can keep prices artificially high by never conducting a stock split, yet not have the underlying foundational support. You may not make any assumptions based on the price alone. Now understand how to buy the stocks. You can buy stock directly using a brokerage account or one of the many available investment apps. These platforms give you the option to buy, sell, and store your purchased stocks on your home computer or any smartphone. The only differences between them are mostly in their fees and their available resources. Both traditional brokerage companies like Fidelity or TD Ameritrade and newer apps like Robinhood or Webull offer zero commission trades from time to time. That makes it a lot easier to buy stocks without the worry of commissions eating into your returns down the line. Now I'll tell you how to choose a stockbroker. There are two types of stockbrokers, full service and discount. Full service brokers tailor recommendations and charge higher fees, service charges, and commissions. Most investors are willing to pay these higher fees because of the research and resources that these companies provide. The majority of research responsibility falls on the investor with the discount broker. The broker just provides a platform to perform trades and customer support whenever needed. Newer investors can benefit from the resources provided by full service brokers, while frequent traders and experienced investors who perform their own research might lean toward platforms with no commission fees. A money manager might also be an option. Money managers select and buy the stocks for you, and you pay them some fee, usually a percentage of your total portfolio. This arrangement takes the least amount of time because you can meet with them just once or twice a year if the manager does perform really well for you. So, learning how to invest in stocks might take a little time, but you will be on your way to building your wealth when you get the hang of it. Read various investment websites, test out different brokers and stock trading apps, and diversify your portfolio to always divide your risk. Keep your risk tolerance and financial goals in your mind, and you will be able to call yourself a shareholder before you know it. So, if you found this video informative, then make sure to press the like button and subscribe to our channel so that you can receive notifications for our upcoming videos on money saving and investing. Thank you.